Right now, the price you'd pay for a silver bar really depends on which side of the planet you're on. Over in China, it's selling for a huge premium compared to the US price. In this explainer, we're going to dig into why this gap exists and what's stopping traders from cashing in on it. Okay, so let's just dive right in. It seems like a simple enough question, right? But the answer is, well, it's complicated. It really depends on where you are in the world. If you thought there was just one global price for silver, what's happening in China right now is going to be a real eye-opener. Here it is. This is the number that has the entire market buzzing. In China, getting your hands on a physical silver bar will cost you a whopping 16% more than the price you see on COMEX, which is the main exchange here in the US. Now, in the world of global commodities, a gap that big is, well, it's practically unheard of. To really wrap our heads around this gap, the first thing you need to know is that we're not just talking about one price for silver. Right now, we're actually tracking three very different ones. This table just lays it all out perfectly. On the left, you've got the US price from the COMEX exchange. Then, in the middle, that's the price for what they call paper silver in China. Think of it as a contract to buy silver, not the actual metal itself. And then way over on the right, you see that much, much higher price for an actual physical silver bar in China. The difference is pretty stark. And this chart just makes it crystal clear, doesn't it? You can really see the jump. The price for a physical bar in China just towers over both the US price and even China's own paper market. It shows people are willing to pay a huge premium for the real thing. But here's what's so surprising about all this. This massive price gap is a very new thing. I mean, just a few weeks ago, the market looked completely different. Just look at how fast things changed. Before the middle of December 2025, it was pretty normal for silver to actually be cheaper in China than it was in the US. Then, bam. In just a couple of weeks, the whole situation completely flipped on its head. This quote from a market observer over there really paints a picture. They're saying that for some of the most popular brands of silver bars, dealers are just flat out sold out, and they can't even tell you when they'll get more. For those of us here in the States, that's kind of like walking into your local coin dealer and being told they're completely out of American Silver Eagles, and they don't even know when they can place another order. It's a huge signal of intense demand for physical metal. So this huge difference in price leads to a very logical question, especially for anyone who follows financial markets. If silver is so much more expensive in China, why don't people just buy it in the US and sell it over there for a profit? That idea has a name. It's called arbitrage. It's really just a fancy word for a simple concept. Buy low, sell high. Normally, in a connected global market, traders would be rushing to buy the cheaper silver in New York, ship it to China, and sell it for a nice, tidy profit. And that action, that selling, would increase the supply in China and eventually close that price gap. But it's not happening. That gap isn't closing. So what is stopping these traders from jumping on what looks like a pretty obvious, almost risk-free opportunity? And the answer, as it so often is in these situations, comes down to the hidden costs of doing business. It's not nearly as simple as just buying a bar in one country and selling it in another. Let's just walk through the journey. First, a trader has to buy the silver in New York. Simple enough. Then they have to pay for secure shipping and insurance to get that valuable cargo all the way to China. But the real showstopper, the biggest barrier, is that final step. Once it arrives, China slaps a 13% value-added tax on the total cost. So there's a little bit of good news for traders. They don't have to pay a separate 10% customs tax on silver bars. But they absolutely cannot avoid that much bigger 13% VAT. And what's really critical to understand is that the tax isn't just on the price of the silver itself. It's on the entire value of the shipment. That includes all those expensive shipping and insurance costs. So when you add up all those costs, you've got the shipping, the insurance, and then that big 13% tax on top of everything. A trader needs the price gap between the US and China to be around 20% just to break even. That's the barrier they have to clear. By the way, if you're finding this breakdown helpful and you like our videos, please take a moment to like, share, and subscribe so you won't miss any of our future updates. So here's the crucial point, the whole reason this gap exists. That 16% premium we're seeing, as massive as it seems, is still stuck in this kind of no man's land. It's not quite high enough for traders to make a profit after they pay all those taxes and shipping costs. The incentive just isn't there. Yet. So what does this all mean for you? What should you be looking for? Well, here's the key takeaway from this whole situation, the one number you'll want to keep your eye on. The number to watch is that 20% threshold. Right now, the price premium in China is bouncing around 16%. If you see that number start to creep up, and if it crosses 20%, well, that's the magic number. That's the point where arbitrage could finally become profitable, and that might allow a whole new flood of supply to pour into China, which could change this entire dynamic. And that really leaves us with a final fascinating thought. This whole situation is a perfect example of how things like taxes, shipping, and logistics can effectively cut off a huge market like China from the rest of the world, letting it create its own unique price. It shows how the demand for physical stuff can really diverge from the paper markets. And the big question is, what happens if that pressure just keeps building?